Chapter 1. Starting a proprietorship, changes that affect the accounting equation. Section 1.1. Accounting in action. So what is accounting and why do we use it? Accounting is how we keep track of money and things of value. Accountants call money cash and things of value an asset. We also have cases where we owe money, in which case we call that a liability. Yes, there's a lot of definitions in accounting, and most of them will make sense and are used for clarity, except when dealing with investing, in which case a lot of them are used, unfortunately, to keep it very complicated and make it so that you have to go through a professional. But we're going to stick to basic accounting terms that don't change. So an asset versus a liability. Since we're looking at what is an asset, a thing like a car is an asset. You can trade a car for money. A bar of gold is an asset. You can trade a bar of gold for other things. So assets are things that have value that you can sell for cash. So let's take a look at a couple of examples. If we take a look at a car is an asset that has a lot of value at the start, but over time, as you use the car, the value of the car goes down. If we take a look at a house, again, an asset worth a lot of money at the start, and over time, generally the asset increases in value and you can get more money for your house due to inflation, property value, etc., as long as you maintain it. So the opposite of an asset is a liability. So if you owe somebody money, if I owe my friend $20, I have to keep track of the fact that I owe him $20 until I pay my friend the $20. Next is net worth. Net worth combines the assets and liabilities to tell you how much cash value you have. A personal net worth statement lets you know your value in monetary terms. As a young person, generally, you have to pay for a car, you have to buy a place to live, you have to pay for an education, so you start off with a negative net worth. And over time, as you get and earn more and more money, you pay off those liabilities and your net worth will increase, become positive, and hopefully very, very positive. Is used to keep track of your net worth, and your net worth can help you make better decisions and especially better monetary decisions to increase your value over time. Businesses work the same way. Initially, the owner puts money into the business, so the business has a liability that it needs to pay back to the owner. The plan is that over time, the business sells services, objects, etc. in order to make cash. Over time, the business grows in value, can pay off its liability, and becomes an asset to the owner. If things don't work well, the business increases its liabilities faster than it increases its cash value, and as a result, normally the owner will shut it down and dissolve the company. And they do that in order to stop the loss of cash value. So now that you have an idea of what assets and liabilities are, let's take a look at Work Together 1-1. So here's our net worth table. So as you can see, we have lots of blanks. We have the assets and the amount. Lower down, we have the total assets, the amounts, the liabilities, the amounts, finally the total liabilities and the amount, and finally our net worth. So we start the first line with a person's name, Megan Finder. The second line is the title, net worth statement, and the third line is the date of the net worth statement. So when you look back at it in the future, you know what day, what did this show. So under the assets, we list the valuables. In this case, she has a checking account worth $800 and a scooter worth $2,000. We add these together to get the total assets of $2,800. Next, under liabilities, we list what Megan owes. She owes JC Auto $920 and she owes River College $125. We add these together to get the total Megan owes of $1,045. Then we need to calculate her net worth, which is the assets minus the liabilities. So $2,800 of assets minus $1,045 in liability gives us a net worth of $1,755. Hopefully you always get a positive value. If you get a negative value, you owe more money than you have, which is generally a bad sign for a business or a person.